your stories,
your freedom.
The Peter Schiff Show.
Welcome, everybody. This is Peter Schiff here at the Peter Schiff Show on SchiffRadio.com on this Wednesday. Welcome aboard. Got a lot to talk about today, so it should be a lively show. First of all, we got the government's official estimates of inflation, came out earlier this morning, and I would have expected the CPI to be a little higher, even with the PPI dropping yesterday. That was not the case. The government's number, the headline number, dropped by 0.1%. And so the year-over-year increase in consumer prices now has declined from 3.9%, where it stood last month, back down to 3.5%. I'd have to think that this is a little bit of a fluke with this decline, given what's been happening with prices, commodity prices in particular, over the last 2 months. We've been talking about oil on this show a lot, and the powerful move in oil. Oil is now up better than $2 a barrel this morning. We're now above 101. We're at $101.50 a barrel. As I've been saying for weeks, we're going to take out $100 a barrel. We have done that. Oil prices are now at their highest level since June. It's not quite a 6-month high. But think about this. The Dow is down 120 points this morning, and the dollar is up. So if oil can rise $2 a barrel on a day when the Dow's down 120 and the dollar index is up, 0.3, imagine how much stronger oil is going to be when the dollar's going back down, when stock prices are rising. I think oil is just a rocket ship. We are up. Oil prices are up. Since their lows in early October, we have a 35% rise in the price of oil. Meanwhile, the media is going to be fixated on this headline CPI and say there's no inflation, yet you're looking at this explosive move in the price of crude oil. And, there's more evidence of inflation that's coming here in China. We had some earnings that came out this week on some of the Chinese companies. One in particular, I don't want to talk about the name of the company because it's not really relevant, but it's a stock that we own, that I own in my account. And the stock was down yesterday pretty significantly because they had a miss on their earnings. And the main reason that they missed was because their margins were really compressed because of a surge in labor costs. Now, they haven't had time to increase their prices to reflect this big increase in costs. I think it's coming, and so ultimately, I think the stock can recover. But again, I don't want to talk about the stock as I don't want to be perceived to be giving any investment advice on the show. But my point is, the costs that went up were labor costs. This particular company was paying workers 10 RMB a day, which is not a lot of money. That's what they were paying last year. Or no, not 10. Let me get the exact cost. It wasn't. Hold on, I have the numbers. What they were paying? They were paying 60. Excuse me. Yeah, they were paying 60 RMB a day. Which is about $10 a day, not quite. So 60 RMB. A year ago, that was what the going wage rate was. These same people, the same workers that were paid 60 RMB last year are now getting 160 RMB a day. That's a 170% increase in the cost of labor for this particular company in 1 year. 170%. Now, this is a huge, huge increase in that input, that component cost. And look, it's not just this one company. Wages are rising all over China in RMB form. It's only a question of time. These prices are going to be built in. Companies are not going to get squeezed. They are going to be raising their prices. There's no question about it. And it's going to be built in. A lot of the imports that are going to be coming into the United States during the next 6 months, they're going to be higher priced. There's no question about it. So oil prices are going to be going up. All these import prices, other commodity prices. This is a big story. the media might not be focusing on it now because they still, have got their heads in the sand, and they're just going to look at the government numbers and not open up their eyes to see what's really, really happening. And, of course, by the time we see the numbers in the CPI, of course, it'll be too late for a lot of people to do anything about it. But I think we're going to see those numbers. Before the end of the year, we're going to start replacing those negative 1% with some plus 0.4 or 0.5 or 0.6. And then we're going to have a much higher trailing number than the one that we have today. Anyway, another story I want to talk about. I hinted about it the other day when we talked I forget what I talked about, but I know it was related to this. But I'm reading a story on home builders that the trend now among the home builders is to build homes that are catered to multi-generational families. Oh, no, I now remember what I talked about. I talked about where students are now, young men are living at home now. They're more likely to live at home. But this is the same idea. It's the same weak economy that is driving this. But the home builders are building homes for 3 generations. That is where you have the grandparents living in the same house as their children and their grandchildren. And so the home builders are now building new homes with the amenities that 3 generational homes would want, like second master bedrooms, a kitchenette, separate entrances. And I looked at these statistics. Again, yesterday we talked about the statistics on young men between the ages of 25 or 35 living at home. Here are these statistics. The number of households comprising 3 generations increased to almost 5.1 million in 2010 from 3.9 million a decade earlier. An estimated 51 million Americans, or 16.7% of the population, lived in homes with at least 2 generations of adults in 2009, up from 42 million. Now, this trend, that I'm sure a lot of that has happened in the last few years, this is because America is getting poorer. And this is also about destruction of housing demand, because if you have 3 generations living in the same house, that's one home that doesn't have a buyer, doesn't have an occupant. Because if it used to be that the grandparents lived in a separate house from the parents, and now they live in the same house, right? That's less housing demand. But why is this happening? Why is the consolidation? Because of the lower standard of living. People can't afford to maintain multiple residences. Plus, a lot of it is the increase in the cost of child care. People can't afford child care, so they need their parents to help them take care of their kids, and it's a lot easier if they're all sharing the same residence. Anyway, we will be back. We'll be taking your calls. We got open lines, 855-4-SCHIFF, if you want to get into the show, 855-4-SCHIFF. We'll be right back here on the Peter Schiff Show on SchiffRadio.com. This is Peter Schiff here at SchiffRadio.com. And, before the break, we talked about the big increase in wages in China, where one company in particular saw a 170% increase in the year-over-year wage rates. This is not happening with a labor union on strike demanding higher wages or some government mandate. This is the market. This is competitive free market forces that are driving these wages higher in China. So this is a big, big deal that a lot of people are just not appreciating the significance of. Meanwhile, also, if you didn't know this from the news, but the police have pretty much shut down the Occupy Wall Street movement in Zuccotti Park. They have cleared away all of the tents and the sleeping bags. The protesters had an attempt to reverse this in court. They lost. They do have the right to protest and picket, but they do not have the right at this point to occupy on a permanent basis Zuccotti Park. They cannot live there. They can protest there, but they cannot make that park their home. Also, I got an interesting sound clip from Vice President Joe Biden acknowledging the degree to which John Corzine was instrumental in helping to design the president's plan. Now, remember, John Corzine is the one who masterminded MF Global into bankruptcy. And, in fact, not only did he bankrupt the company completely, and not only have pretty much almost all the employees now lost their jobs, but it may have even been illegal. He may have even embezzled customer funds, illegally commingling customer funds with their own capital, and not only bet his own money, but his customers' money, and lost big time. This is the architect of the Obama plan. Maybe the plan is that John Corzine can help do for America what he did for MS Global. And you know what? He's probably going to succeed. I mean, maybe Obama's plan for our country will be no more successful than John Corzine's plan for MF Global. But anyway, here's the admission by the vice president. Here, cut number one.
John Corzine helped craft the Republic. It's not coincidental that the things he did here turn out to be the exact same things the Recovery Act has. Because way back in the transition period, before we were sworn in, when Barack Obama and I were literally sitting at a desk in a high-rise in Chicago, beginning to plan how we would try to get this economy out of a ditch, literally, the first guy I called was John Corzine.
Now, of course, the vice president said that back in 2009 when John Corzine was running for governor, and of course he lost that bid to Chris Christie. But I'm sure the vice president wishes he hadn't said that now. I think this would be a great sound clip for the Republicans to use in a campaign against Obama and his economic agenda if they can tie that agenda to John Corzine. Anyway, again, the number to call, 855-4-SCHIFF. We got a guest coming up at the top of the next break, so not sure how many calls we can take between now and then, but you might want to get ready for calls at the top of the second hour. In the meantime, let me go to Chris, who's on hold from Manhattan. Chris, welcome to the show.
Hey, Peter. One comment and one question. The comment is I think the Occupy Wall Street crusade is going to have a ugly moment tomorrow. I think they're going to protest the actual New York Stock Exchange. And I was there maybe a month ago when they tried to do this, and it got pretty ugly. And this is where I think you're really going to see a clash with the police and all that. So not looking forward to that, but I think it is inevitable, and I think it will get ugly.
Why were they discussing? Is that their strategy? Have they been talking about, hey, this is what we're going to do now? We're moving on to the stock exchange?
That's in the news, yeah. They're going to go try to stop the subway, stop the traffic over the Brooklyn Bridge, and they're actually going to try to stop trading on the New York Stock Exchange. And
that's not going to be very successful. In fact, that'll result in a lot of people being in jail.
Right. I think it will get very ugly. I saw them attempt to do this about a month ago. It was at nighttime, which is a lot different, but still, lots of police and horses, guns, and it was scary. And I think tomorrow it's going to be a repeat, but a little bit worse. But my question really is about Bill Clinton, and I never really hear you talk about him, and I was wondering what you thought, or what you liked the most about him, and what you liked the least about him.
Well, I mean, I was not, a fan of Bill Clinton, though I think that, overall, I think that Bush did a worse job than Clinton. I mean, so Clinton wasn't a complete disaster, but, I don't like the fact that, taxes went up under his term. I don't like the tax increases that were made. Obviously, too, he helped preside over a stock market bubble that was fueled in large part by Alan Greenspan. Also, it was under Bill Clinton and his Secretary of the Treasury, Robert Rubin, that we began the refinancing of our national debt out of long-term debt into short-term debt. So that's where that trend started, and that probably could be one of the worst things that happened under the Clinton administration. And one of the reasons that he was able to bring the budget into balance was because we reduced the interest cost. But we only did that by going from, a fixed rate to an adjustable rate, and by moving down. So I think that his presidency was successful economically in the sense that we were in a bubble and we were profiting based on the damage that we were doing long-term to our economy. And a lot of that damage was inherited by Bush. And the collapse in the economy that began early in the Bush term was the result of a lot of the mistakes that happened during the Clinton era. But rather than acknowledging the source of those mistakes and admonishing that administration and adopting free market policies, he made even bigger mistakes that led to the situation that we are in today. But at least with respect to the increase in government spending increased more slowly under Clinton than it did under Bush. And, you know, he got welfare reform. I mean, he wasn't a complete disaster, the way potentially he could have been. He certainly wasn't anywhere near as bad as President Obama is. But certainly, I mean, I wouldn't say that he was a good president. It's just that compared to what? I mean, we've had such lousy presidents in my lifetime that the bar is so low. So I'm not going to say he was good, but he certainly could have been a lot worse, and there have been other people that have been worse. But when people want to long for the good old days of the 1990s, they have to realize that that was a false prosperity. And we paid the price for that in the following decade, or we're really paying the price for it now because we had even more false prosperity under Bush than we did under Clinton.
All right, well, thanks a lot, Peter.
Yeah, but, again, it could have been a lot worse. I mean, definitely. And I think one of the reasons that Clinton didn't do more damage was because we had that Republican revolution in the House. We got the Newt Gingrich, the contract with America. We got gridlock. And gridlock is good because gridlock prevents new legislation from being passed. I think the most dangerous thing that we've got is bipartisanship. When the Republicans and the Democrats cooperate, that's when we really get screwed. And, of course, when we had the Republicans in control of all three branches, or rather both houses of Congress and the presidency, we went on a free-for-all. The Republicans revealed their true selves, their political selves, and just went on a spending free-for-all. That was the problem, But anyway, hey, we got a great discussion coming up next. We got economist and author James Rickards, who's also local here in Connecticut. He's got a new book out. We're going to talk about monetary policy and currency wars when we get back. So stick around. This is Peter Schiff here at SchiffRadio.com. And this is Peter Schiff here at SchiffRadio.com. Joining me now is James Rickards, who is a lawyer, economist, and investment banker. He's worked on Wall Street for about 35 years. He is also a frequent commentator and op-ed columnist at the Financial Times, the New York Times, and the Washington Post. Right now, he's a senior managing director for market intelligence at Omnis Inc., which is a consulting firm. And he's got a book out, his first book, Currency Wars, The Making of the Next Global Crisis, just came out November 10th. James, welcome to the show.
Thank you, Peter. Thanks for inviting me.
Sure. I know you're a local. You actually live here in Darien, Connecticut, where you are also a member of the RTC there. I forget, were you a member in 2010 when I was running for Senate?
Peter, I was actually not only a member, I was a non-committed delegate to the State Republican Convention, and I remember being on the floor with you and Linda McMahon and the rest. It was quite an exciting time. I followed your political career very closely.
Well, the convention wasn't that exciting for me. I couldn't even get enough support in that convention to get on the ballot.
Most of the you made a little noise in the process, and a lot of people were rooting for you.
Yeah, too bad they weren't voting for me, because we actually might have had the Senate seat instead of Blumenthal. But anyway, so your book has just come out, right? Currency Wars. Now, I always joke about the fact that a currency war is like trying to turn your ammunition on yourself and commit suicide. Nobody wants to win a currency war, because I think if you win, you lose.
Well, that's exactly right. It is extremely tempting because the simple analysis is, hey, I can't get enough growth. The consumers are indebted. No one's going to invest if consumption's not there to pick up the output. Government spending is kind of hit the wall because of the Tea Party and the debt ceiling debate we had in August. So the only thing left is net exports, and the fastest way to gin up net exports is to trash your currency. So that's a way to get growth and create jobs. It sounds good. The problem is it never works in practice. The reason is that that there's, first of all, retaliation. Other countries try to devalue their currency against you, so all advantage is temporary. But more importantly, at the end of the day, it's inflationary because it's one thing to focus on the exports, but the United States has a lot of imports. And if we cheapen our currency, then the things we buy abroad, they become more expensive. That inflation trickles into the United States. You get into stagflation. And you're exactly right. At the end of the day, it always ends badly, but people just don't get it. One of the things I do in the book is I turn to history and go through the history of what I call Currency War I from 1921 to 1936 and Currency War II from 1967 to 1987. And I show how these things ended really badly, whether it was Great Depression, World War II, going off the gold standard, the trashing of the dollar. They just end badly, and that'll happen again, but it doesn't stop people from trying.
Yeah, people don't seem to understand that the reason that lowering your currency causes more sales is because you're lowering prices. It's like, yeah, anybody, if they want to sell more stuff, you can just put your goods on sale. But you're not. It's better to sell your stuff at full price. If you just put everything on sale, you're earning less for your exports. And why do you want to earn less for your exports? Because that means you can't afford your imports, which is the only reason you're exporting. So you just shoot yourself in the foot.
Well, that's exactly right, Peter. Global supply chains today are very complicated. I mean, take the iPhone, for example. We all love our iPhones. They come from China, and there's this naive assumption that if you can devalue the dollar against the Chinese yuan, that'll cut down on those imports. But the fact is we don't make iPhones in the United States. People are still going to buy them, so they're just going to have to pay more in terms of dollars. It doesn't mean we're going to buy any fewer of them. But the other problem is only 6% of the value added of the iPhone comes from China. In other words, cutting the dollar by 50% against the Chinese yuan is only going to change the price of an iPhone by 3%. Most of the value added in iPhone comes from Japan in terms of the touch screens, from Toshiba, South Korea, Germany, and elsewhere. So you end up having to devalue your currency against every currency in the world in order to cut through the supply chain. And then, of course, the other currencies do the same thing. So you're just no further ahead. You create inflation. What we've been doing, the Fed has printed over $2 trillion of paper money in the last 3 years, and a lot of people warned about inflation. But the supporters of the Fed, Paul Krugman and others, have said, hey, look at the price indices. You don't see any inflation. Well, the reason for that is it all went to China because China was soaking up the extra dollars and had to print their currency to soak up the dollars. So inflation broke out.
Absolutely. I mentioned on the show earlier, because I have one of the Chinese companies that I own reported disappointing earnings yesterday, and the main driver was a 170% increase in year-over-year labor cost. People that they were paying 60 RMB a day a year ago, they're now paying 160 RMB today. That is a 170% increase in the cost of labor in 1 year because of all the money that the Chinese are printing to buy up all those dollars.
Right, and that's exactly right. And finally, the Chinese got spooked by the inflation because inflation historically has been very destabilizing in China. So they did allow the yuan to appreciate against the dollar, let the dollar go down. So in the short run, it looked like the Fed was winning the currency wars, but it's only round one of a 15-round fight. And the problem now is that our inflation, instead of going to China, it's going to come back to the United States. All that inflation that people are worried about, which has been showing up in China, is now going to show up here. So
absolutely. That's what I've been saying for years. And in fact, look at the price of oil today at $101.50 a barrel. It's up 35% since October 4th. You're seeing a lot of strength in these commodity prices. In fact, if you look at it seasonally, the price of gasoline is at a record high right now based on this time of the year.
That's right, and I think this is just the beginning. We're seeing it. Some of the price indices were a little hotter when you take into account food and energy. Now, people like to strip it out and look at core, but that's as I say, you do have to drive your car and you do have to eat every day. So I think that's a fairly loaded assumption. But that'll come back, and that's just going to hurt unemployment. We've got 46 million Americans on food stamps. We've got over 20 million Americans either unemployed or underemployed. This is one of the. I don't think we're in a recession. Actually, I think we're in a depression. I think it's the depression of 2007. It's going to last until 2014, maybe longer, depending on policy. And the best description of depression economics I've ever heard comes from a Paul Simon song called "Allergies." He said in that song, "We get better, but we never get well." In other words, you can have periods of growth and declining unemployment in a depression, but you never get out of it because of the debt overhang. And until we break up the banks, write off the debt, have a strong dollar and lower taxes, we're not going to get out of this.
Well, absolutely. I couldn't agree more. And, of course, that's not what we're doing. We're getting more regulation. We're getting more printing. We're getting the Fed now committed to keeping interest rates at zero, despite the fact that inflation is getting worse. Now, in your book, you're talking about the making of the next global crisis. I've been saying that the real crash that's coming is a dollar crisis. Is that what you're seeing in the currency wars, a big drop in the value of the dollar?
That's exactly what I'm talking about, Peter. And I make the point that if the dollar crashes, all of the dollar markets crash with it. Everyone's looking at stocks or bonds or commodities or other markets. But what about the dollar itself? If people lose confidence in the dollar, then all of a sudden, your dollar-denominated stocks, bonds, and other instruments are going to be worthless. And by the way, this happened in 1921, 1922 in Germany during the beginning of the Weimar hyperinflation. When that inflation started, the people in Germany actually were not that concerned because their stock market was going up. They said, well, okay, the cost of living is going up a little bit, but my stocks are going up. What they didn't realize was that the stocks were going up in a soon-to-be worthless currency. I mean, what good does it do you if you have infinite dollar prices of zero value? In other words, the value of that is zero. And so that is the ultimate crisis. And we actually, I worked with the Pentagon and the intelligence community to do a financial war game a few years ago where we looked at these kind of outcomes, not in the economic sense, but in the national security sense. And the book actually does kind of combine economic concerns with national security concerns. You cannot have a strong country with a weak currency.
Yeah, I think that, and we can talk about this after the break, that I think that it is a much greater national security threat, our solvency, our indebtedness, this potential collapse of our currency, than any threat coming from Iraq or Iran or Afghanistan or Libya or any terrorists. I mean, we're terrorizing ourselves. This is really what we have to worry about, is the impact of a collapse in the value of our currency, because basically that's how the U.S. economy works right now. We depend on being able to print money to buy the stuff that we need, and we have to be able to borrow money in our own currency at low rates of interest to keep this whole house of cards afloat. And I think you're right. I mean, what's happening in the stock market today is pretty much the same thing. I think all the gains that we get are purely the result of inflation. It's not because the economy is improving. It's because money is losing value. And that's where you see that all these asset classes are kind of have a correlation of one, where they all rise and fall together. Commodities, precious metals, stocks, because it's all a function of the value of the dollar. When the dollar is gaining value, then other assets are declining, and when the dollar is losing value, they're rising. And it's really an inflation aversion trade that's going on.
Right. I told the Pentagon, don't worry about China destroying our markets because we're doing a good job of it ourselves.
Well, I think if the Chinese wanted to destroy our market, they could. All they have to do is start selling their treasuries.
Well, that's right, but a lot of people don't realize that if China did that, the president has dictatorial powers, and I don't say that in a hyperbolic sense. It's actually the law. There's a statute called the International Emergency Economic Powers Act of 1977, signed by President Carter, and it gives the president dictatorial powers to deal with an economic emergency. So if the Chinese ever did try to dump treasury bonds in a malicious way to destroy our economy, with one phone call to the Fed, the president could freeze those accounts because they're all book entry. I mean, there are no physical treasury securities. It's electronic book entry.
The Chinese don't have to dump anything. All they have to do is let their bonds mature and ask for their money. I mean, is that somehow a crime to just say, hey, the T-bills that I own mature, I'd like my money back? That would that be seen as like a hostile act of war? Not to want to roll it over. That's why they have short-term treasuries, right? Because they don't have to roll it over. But anyway, let's talk about this when we get back. You're listening to the Peter Schiff Show here at schiffradio.com. And we are back. This is Peter Schiff speaking with James Rickards, author of the new book, Currency Wars, The Making of the National Global Crisis. And, Jim, before the break, just discussing China's $2 trillion plus holdings of U.S. Treasuries. The vast majority of that $2 trillion is in short-term paper. So if the Chinese really wanted to tank our markets, they don't have to sell anything. All they have to do is refuse to buy treasuries when their existing treasuries mature. Could we really punish them for not loaning us more money?
Well, you're right, Peter, in the sense that they have shortened up the maturity very significantly, and that's something I think the U.S. played right into their hands by shortening up the maturity of the issuance. In other words, we as a country have a choice as to what maturity structure we want to put on our debt. The Treasury can issue 30-year bonds, 10-year notes, 30-day bills. Well, at the same time as the Chinese have expressed an appetite for shorter maturities for the reason you mentioned, which is you don't have to sell anything. You can just sit there and let them run off, and the Treasury sends you the dollars. Well, why is the Treasury issuing the shorter maturities? If interest rates are so low, there should be an opportunity to issue longer maturity debt, but the Treasury has chosen not to do that, probably because they wouldn't like the answer. If the Treasury actually did try refinancing the U.S. debt on 10-year and 30-year terms, they might.
Yeah. Well, there's two reasons they're doing this, and they're both reckless and irresponsible. One is to mask the current cost of servicing the debt. Even though long-term rates are still historically low, they're a lot higher than the T-bill rates, and so you can make the current debt service smaller by doing this, but of course it's economically irresponsible because you're pushing the cost into the future. But the other reason they're trying to do it is they're trying to keep mortgage rates low. A lot of Americans are borrowing money for 30 years on a fixed rate mortgage, and that's tied to these long-term T-bill rates. And if the government actually tried to sell a lot of long-term debt, the yield on that long-term debt would have to rise, and that would mean mortgage interest rates would rise as well, and they don't want that. They want to keep rates down. So this is all the gigantic Ponzi scheme that's going to blow up, and this is a crisis of our own making, just like the housing bubble. But of course, as the housing bubble was inflating, nobody criticized it. We all let it go on, and then after the fact, we complained about it. We're making even bigger mistakes now with the way we finance the national debt. It's going to lead to this huge crisis, yet nobody is doing anything about it while you still can.
Well, that's exactly right, Peter. We're actually playing into the Chinese hands in another way, which is China's going out and getting as much gold as they can, as fast as they can. China is a paper giant, but they're a gold pygmy. The United States has 8,000 tons. China only has a little over 1,000 tons, at least officially. But they're doing a number of things. They've gone from back in the pack to being the world's largest gold producer in a very short period of time, just a few years. They currently produce over 300 tons a year, which is by far the largest single producer in the world. And they've got their military and their intelligence services out trying to acquire gold covertly. Of course, if you go through the London market, that market is so thinly traded that the market impact would drive the price of gold to the moon right in front of their faces. So they're trying to acquire it indirectly. They're also buying gold mines and taking the output, smelting it, and sending it directly to Shanghai. So basically getting their gold directly from the mines, like getting your milk from the cow and bypassing the marketplace. So they're doing everything possible. But the problem is this is really non-sustainable. People say, gee, if they produce 300 tons a year, doesn't that mean they'll have 3,000 tons in 10 years? The answer is no, because those mines are going to be depleted in 2 or 3 years. They're leaching the gold with cyanide, dumping cyanide into the rivers. They're doing a lot of non-sustainable things. So at the end of the day, China's not going to have enough gold. I do think the paper money system is in danger of collapse, but when that happens, the U.S. has a secret weapon, which is we can go back onto the gold standard. Of course, to do that right, you're talking about levels. I have a range of levels in my book, Currency Wars, from a low end to a high end. The low end is $3,000 an ounce, but the high end is $44,000 an ounce. And these are not just sort of made-up pie-in-the-sky numbers. There's actually a model that I describe. You have to answer a couple questions. You have to say, all right, every gold standard is a relationship between paper money and gold of some kind. But what paper money are we using? Are we talking about M0, which is so-called base money? Are we talking about M1 or M2? There's a big difference there. The second question you have to answer is how much gold backing do you want behind the money? The hardcore gold bugs would say it has to be 100%. But historically, England ran a gold standard with 20% backing, and the U.S. ran a gold standard with 40% backing. But you have to pick a number. The third thing you have to answer is it just the United States, or is it all the major countries in the world? I think it has to be all the major countries in the world, because if the U.S. went to gold, it would be the only currency anybody would want. You wouldn't even touch the euro or the yuan. So if you put everybody in the pot, you need much higher gold prices, at least in dollar terms, because no one else has as much gold as the United States. So you have to, for example, if you say, 100% backing of M2 for U.S., ECB, and China, that's the $44,000 number. If you say 40% backing of M1, you get to something around $7,000 an ounce. So you do get very different results, but they're all far higher than where we are today.
Well, absolutely. And I think going back to a gold standard is easier than going off a gold standard. I mean, when you go off a gold standard, you're basically trying to convince people that money backed by nothing is better than money backed by something. That seems like a big feat to pull off, as opposed to telling people, right now your money has nothing behind it. Now we're going to actually make your money have real value because we're going to have something tangible backing it up. It seems that that's an easier transition to make than the one that we made in 1971.
I agree with that, Peter, but it's really important to get the price right. And I'll give an historical example. There was something called the gold exchange standard of the 1920s and 1930s, and that standard failed, and it's been the basis for disparaging gold ever since. Generations of economists, including Ben Bernanke, Paul Krugman, Barry Eichengreen, and others, say we can't go on a gold standard, and they point to the 1920s gold exchange standard as the reason. The problem is that gold exchange standard of the 1920s and 30s did fail, but it didn't fail because of gold. It failed because of the price of gold. Winston Churchill, who was Chancellor of the Exchequer in the UK at the time, wanted to go back to the pre-World War I gold price of $20 an ounce. The problem is they had massively printed money to fight World War I. Well, if you go back to the old price and ignore all the paper money, that means they had to cut the money supply in half to maintain the price, and that was deflationary and it was depressionary. It did cause a depression. If we had gone back to gold in 1925 at, say, $50 an ounce instead of $20 an ounce, it would have been mildly inflationary, and we might have avoided the Great Depression. So fast forward to today, I agree with you. We should go back to the gold standard. It would be very straightforward, and it would give people confidence in their money. But it's really important to get the price right, because at $1,700 an ounce, which is where it is today, that would be repeating the mistakes of the 1920s. That would be highly deflationary.
Yeah. And I think the best way to get the price right is to let the market set it. You can't have the government try to set it. The government, so you want to have the government announce its intention. This is what we're going to do, and the market's going to have to figure out what gold price would make it work.
That's exactly right. The Fed conducts open market operations today to set interest rates. You could do the same thing in gold. Let's just say theoretically $5,000 an ounce looked like a reasonable price. Well, you could take the price of $5,000, but then say to the Fed, you're a buyer at $49.95 and you're a seller at $5,050, and maintain the price. If you've got people lined up to sell you gold, then the price should be higher. And do that for a couple of years. What a radical idea. Let the markets actually...
yeah, absolutely. Anyway, hey, we're out of time. I appreciate you coming on the show. Good luck to the book. And if I run next time, I need your vote. Anyway, we will be back. We got another hour coming up on the Peter Schiff Show here at SchiffRadio.com. Stick around. This is Peter Schiff, SchiffRadio.com, Hour 2, getting underway right now. We've got some open phone lines, 855-4-SCHIFF, 855-4-SCHIFF is the number to call. Looking at the crude oil market now, as we got crude oil at $102 a barrel, not only is crude oil prices rising sharply, but look at the differential between the West Texas and Brent. That differential is now just $10. That it's been cut in half in the last 6 weeks from where it was. So this is a lot of momentum. Not only is the West Texas price rising, but it is also rising relative to Brent, and that is even more bullish. So the market looks like it's going up. Obviously, as I've been saying, we're getting close to my short-term targets for price movements, where we might see a little bit of resistance overhead in the crude price. I think the resistance is going to come in anywhere between this 102 and 105 area, that we'll see a little bit of overhead resistance. So I don't think we're just going to make a beeline for 115. I think that we will run into a little resistance, but who knows? I mean, this is a very powerful move. Maybe it'll get through this level like a hot knife through butter, but the bigger resistance is waiting around that 115 level, which is the high from this year back in May. And after we hit that high of 115, we went all the way down to a low of 74.95, made just 6 weeks ago. Is when we hit that low, and it's been a 35% rocket shot ever since. Anyway, moving along, briefly want to mention the post office. I've talked about this before. They came out yesterday and announced their losses. The losses were over $5 billion at the U.S. Post Office. And, of course, the losses would have been even more than that had they not been able to not make certain contributions to their pensions that legally they were required to do, but the government gave them a pass. So they lost $5.1 billion, but they actually would have lost something like $10.6 if they had to use honest accounting. And, of course, one of the other problems is they're losing all this money despite the fact that they're selling these forever stamps. They're doing a pretty brisk business selling forever stamps. Now, these forever stamps, I've talked about before, these stamps give you the ability to mail a letter in the future based on today's stamp price. You don't have to add, the additional postage. And so because of that, people are stocking up on these stamps. So the post office is selling stamps for mail it hasn't even delivered yet. So imagine how much bigger the losses are going to be for the post office when in the future they raise the price of the stamp, and then instead of buying new stamps, people just start pulling out the forever stamps that they already bought. Now the losses are going to swell because the post office is going to have to deliver mail for which they've already been paid, but the money has already been spent on the money that had been delivered in the past. So this is a ticking time bomb at the post office. It's going to be another federal bailout, maybe even before the next election. We'll see, but they are rapidly collapsing. And, of course, this is the model upon which we want to base our health care system. We want to basically empower the post office to manage health care, despite the way that they have managed the postal system into bankruptcy. Anyway, before I get back to the phones, I see some people calling up. I want to mention a little bit about the phone banking effort that I see is getting underway now by the Ron Paul campaign. And I went to the website today myself to sign up for phone banking for Ron Paul. It was actually pretty easy to go to the website and do it. I wanted to try, but it was too early in the morning. I think you can only phone bank after 10:30 a.m. Eastern time. So I'm going to try to make my first calls later today, and I'll be able to talk about how it went tomorrow on the show. But I would encourage everybody to sign up for the phone banking program for the congressman. I think it could make a big difference. It could be the difference between winning and losing in states like Iowa and New Hampshire. And if Ron Paul could actually win Iowa, the media can't ignore him. I mean, if he comes in second place, maybe they will. But if he comes in first, they can't ignore that. And it's a tight race. You saw the polls. I talked about it yesterday. All these candidates are bunched up. Ron Paul was in second, but technically they're all about the same, these top four guys. The difference could be the phone banking. 20% of could win. 20 to 25% could win Iowa or New Hampshire. So all we have to do is sway maybe 5 to 10% of the primary voters. Remember, when we did the phone banking for the Schiff for Senate campaign, we only really did it for about a month of really solidly doing it. It took a while to get the bugs out of the system. But in that last month, my polling numbers went from nowhere. I was polling 4 or 5%, in the margin of error. I got 23% of the vote in that primary. I think a large part of that came as a result of the phone banking. Unfortunately, we started the effort too late, and not quite enough people participated. We had about 100 people a day making calls. We were making 5 to 10,000 calls per day to registered Republicans in Connecticut. Ron Paul has a lot more people around the country backing him than I did. Imagine all these Ron Paul supporters making 50 to 100 calls a day into small states like Iowa or New Hampshire. That could make a huge, huge difference. So we need to get people getting into this phone banking because I think we could overwhelm our opponents in this race by doing this phone banking. He's got a lot more volunteers than I did. And I had people from all around the world making phone calls for my campaign. So we got to get that enthusiasm going for the Ron Paul campaign. I'll try to talk to them. I think they should also replicate what we did. You remember, we had daily contests. We were keeping track. We were announcing the winners every day, who made the most calls. We had small prizes. I was sending out copies of my book. We were giving out T-shirts. I think all that helps. I think we want to turn this into a contest. We want to make it fun. We want to see who can make the most phone calls for Ron Paul. And if we do this, I mean, we really have a shot. If he could win one of these early primaries, he's going to get media attention. And that's been the problem, that he hasn't gotten the attention of the media. He's raising plenty of money. I mean, it's not on the money front that he needs help. It's the media that he needs help. And he'll get more media if he does better in the polls, if he can win some of these primaries. And certainly the phone banking efforts could work. So you got to go to the website and sign up. It's Ron Paul. Let me see what it's phone.ronpaul2012.com. I think that's the website. You just got to do a few things. You give him an email address, give him a phone number. You get a couple of quick automated responses. I signed up. The whole thing took maybe a minute earlier this morning. And so, I'm going to do it later today. I'll talk tomorrow about the results that I have in the phone banking. If anybody else is already phone banking, give me a call and, let's talk about the response that you're getting. Anyway, we'll be back. We got a lot more of the Peter Schiff Show coming up here on SchiffRadio.com. Stick around. We've got your calls coming up after this break. I am back. This is Peter Schiff. I'm not sure I've heard the Peter Schiff Minute played before on the Peter Schiff Show. Not sure it's the best use of our time, so maybe that was a mistake. We should use that time period more efficiently. Everybody who's listening to the Peter Schiff Show knows about the Peter Schiff Show. I think those minutes are meant to promote the show on other shows. But anyway, let me go and quickly take a few phone calls. First up is going to be John calling from San Diego. John, welcome to the show.
Hi, Peter. Thanks. First, I just want to thank you for what you're doing on this show and in the media. You're really giving a voice to Austrian economics and basic economics, really. And I think the messages of, underconsumption and credit derived from savings really has a chance to resonate with a lot of people. So thank you.
Thank you.
But my question is, have you seen this video on YouTube? It's called Fraud. The Federal Reserve is selling put options on treasuries to drive down yields.
I haven't seen that video.
Yeah, it's basically this guy. He went through a bunch of meeting minutes that I guess are published at the Fed website, the Open Market Committee minutes, and he kind of illustrates how the Fed is packaging these put options with the Treasury bonds they're selling in order to, I guess, increase demand, and kind of like, I guess it's the concept of insuring their bonds, kind of like how they insure our deposits at the bank to have this false sense of security. And it just really opened up my eyes to how desperate and how active the Fed is to get these bonds out. And I just wondered if you could comment on that at all.
Well, that is the name of the game. It's to keep this whole house of cards going requires the constant issuance of new debt, and not just new debt, but very low-yielding debt. That is the whole thing. I mean, the only reason that we are not imploding is because we're borrowing money at practically zero cost. And the minute that comes to an end, this whole house of cards that we've erected collapses. And it is, like I said, it is amazing how few people understand the nature of this problem. I mean, we are staring at a disaster that is far greater in magnitude than what happened in 2008. Yet, nobody in power can see this thing coming despite the size of the problem and the ample warnings. I mean, the warning sign, this is basic math. This is easy. I mean, I thought seeing the housing bubble was easy. This is even easier.
Right. And I just want to say, too, if Ron gets in office, maybe if he gets this primary, I think, you'd be a pretty good choice for Secretary of Treasury, and maybe Judge Napolitano for Attorney General. How would you think about that?
Well, I would help Ron in any way that I could if he were to invite me to be part of the government. But I am not going to, accept the position that hasn't been offered to me. I don't even want to assume that I would be the best qualified to take that position. But I would love to be an American citizen with Ron Paul as the president. Even if I wasn't actively involved in his administration, I'd be pretty confident that some of the right decisions were being made, even if I wasn't a part of the process. But thanks for the call. Next up is Dustin calling from Medford, Oregon. Dustin, welcome to the show.
Hey, Peter. Thanks for taking my call this morning.
Thanks for calling.
So I kind of have a question about interest rates. Right now the Federal Reserve is setting the rate, but can you give me a more detailed explanation about, I guess, how interest rates would function in a more free market environment?
Well, sure. Well, the interest rate would be set like any other price. I mean, there's no government agency that determines what the price of a cell phone should be, or what the price of a pair of tennis shoes should be, or all these prices are determined by supply and demand, and interest is the price of borrowing money, and it's determined by the supply of savings to be loaned out and the demand to borrow those savings, and just let the market set a rate, and the Fed doesn't have to do it. And the market will set a rate, obviously, that's going to be quite a bit higher than the rate we have today. The problem with the rate being so low today is the government has distorted savings and borrowing. Not enough people want to save because the rates are so low, and a lot of people want to borrow because the rates are so low. And so we have this big gap between the savings and the borrowing, which is now being filled with a printing press. And that doesn't work. This way leads to disaster. We need to have a market mechanism to set interest rates so we have the proper balance between savings and consumption.
Yeah, and I agree with that 100%. So would the interest rate, would it fluctuate bank to bank? Would each bank have a different rate then?
No, the rates, depending, now, if you got the government out of the banking sector, right, if the government no longer insured deposits, then yes, banks would have different rates depending on the perception of safety of the individual banks. So safer banks that had better balance sheets might offer lower yields than banks that were riskier. But in an environment where the government is guaranteeing all the bank deposits, then it really doesn't matter. The only thing might be, do you get free checking? How many ATM machines do you have? Can you use your debit card? There might be other things that might, at the margins determine slight differences between the interest rates. But in general, no, the rates would be pretty similar throughout the industry, and they would be a lot higher than they are today.
Yeah, I agree for sure. It would just be weird going to a bank, if, let's say, the FDIC were dissolved and, you put your deposits, at your local bank. It would be really strange, I think, a strange concept for people to think that those deposits weren't insured by the federal government. That's just a strange concept, I think, for people today.
Well, people would now be concerned about where they put their money. And it doesn't mean that the banks wouldn't be insured. They might buy insurance in the private sector. But if they were going to buy insurance, let's say from a Lloyd's of London or a big company, that insurance company is going to audit them a lot more responsibly than the FDIC would be. After all, it's their own money that's on the line, and they're going to make sure that they're doing a good job. So there still could be insurance in the banking sector. It would just be provided through the private sector, which would be a much more reliable way of doing it. It would condone itself to a much healthier banking system. But of course, there could be banks run by very reputable people that don't have insurance, that advertise how safe their banks are. You could have independent rating agencies, not licensed by the government, but kind of like a Consumer Reports that can come out with its own version of banks and which ones are the safest. You can have, how Frommer's, they put their stars on restaurants or what the numbers, how they rate them, and you can get a guide. There might be companies that would do that with banks, and the banks that had higher ratings or more stars would be able to attract more deposits. I have no doubt in my mind that we can have a more solvent banking system if we got rid of all those government guarantees and replaced true free market discipline. After all, people don't want to lose their money, and they're not going to deposit it in a bank if they think they're going to lose their money. So I want the people to have money on the line, their own money. That's the best regulation to make sure that the banks that get that money are safe, not when you abdicate the responsibility to some third party in government who couldn't care less about individuals and their money and who was just making decisions based on what's good for him politically.
Right, I get that.
But anyway, yeah, well, hey, thanks for your call. It's an interesting topic. Anyway, we're up against a break. We'll be back. We've got another half hour coming up of the Peter Schiff Show, so stick around. We'll take more calls, 855-4-SCHIFF. Don't go away. This is Peter Schiff. We are back here at SchiffRadio.com. Taking phone calls, 855-4-SCHIFF. We do have open lines for people who want to call. Next on hold is Greg calling from Wilmington, Delaware. Greg, you're on.
Good morning, Peter. Thank you for suggesting people go to the Ron Paul phone banks. And an additional suggestion that I'd have that I used last time that worked pretty well is if any of your listeners have an unusual last name like I do, is you can use the online white pages and find people with your same last name, and if you call them up, they're quite thrilled just to find another person with their last name, and it more personalizes the discussion. And if you're have friends in that state, and what I did is just followed the campaign last year or 4 years ago across the country, and whatever state he was in, I would just call people with my last name. I'd send letters, and it would make them much more likely to open because they could relate to the person.
Yeah, although I think, you're probably not going to have that many people with your last name, so I think you can make a couple of them just for kicks. But I think in general, if you just do the phone banking, especially in some of these primary states, people are pretty political there, and they're probably mainly used to getting a robocall or something like that. So if an actual person calls them, they might be a little bit more receptive than a machine.
Well, yeah, and I guess that's my point. Is you're talking to them as a human to human rather than just some what do you call it, telemarketing type of call. So can I shift gears and ask you another quick question? Do you know of any software that would allow you to compare anything against anything else? For example, the price of corn compared to the price of Microsoft stock or something? Because I always think, now that money doesn't really mean anything, I have a theory that stuff buys other stuff. So if you can figure out what...
Yeah, I don't know. I know they definitely have that with gold and certain things. I don't know if there's a website. It might be interesting because it'd have to have all the data. Where you can look for the price of one thing expressed in the price of something else. It has to have all the data on all the prices. But once it has that, then it's a relatively simple procedure to express one variable in terms of another. But I don't know that there is a site that already exists that will do that for all these different things. Although I do think there are sites out there that will show you gold price in terms of silver, the Dow price in terms of gold. But I'm not sure if you can simply substitute the price of anything you want for the price of anything else. Like give me the price of IBM stock in terms of corn. I don't know that you could just you could choose it like that.
Yeah, because I know there was I traded a few commodities, and there was one guy that for years before the world figured it out would do nothing but compare the price of corn compared to the price of cattle because, corn make cattle. And whenever that was out of whack, he would just trade whatever way was out of whack, and it was a pretty successful trade.
Yeah, I mean, certainly it's a good trading tool, but I was thinking it more just to take a look at what's happening to prices of one thing in relative to something else. And I think that if you do that, pretty much you're going to see that prices are falling in terms of any given commodity. That's a better way to see how much inflation there is, because most people are pricing things in terms of dollars, and I think that really doesn't give you a good picture of what's really happening to prices. So I think if you price assets or certain things in terms of commodities or different commodities, you'll see a much different result.
Yeah, I mean, it's fascinating. Like when I started buying gold, I think it would take something like 200 ounces to buy my home, And now I could buy like 5 similar homes for that, just in 10 years. So it's amazing.
Yeah, and I think that's going to keep happening, especially, look, we spoke with my guest earlier today about if we go back on a gold standard, where would the price of gold have to be? $3,000 an ounce, $4,000, $5,000. So if we do go back on a gold standard, which I believe we will do eventually because we'll have no other choice, prices for homes will be much lower. In terms of gold than they are today, as will the price of just about everything else. That's why I own so much gold personally. That's why I own all these gold stocks. I'm just so confident that the price of gold is going to go up. I wanna have a lot of leverage. I want to own a lot of gold because most people don't own a lot of gold. They hardly own any. And I think in the future, people are going to have a lot more gold. And that's when I'm going to sell mine and use it to buy other things that I'm not buying right now, because I think the prices of the other things that I want will be a lot lower in the future. So I'm keeping my powder dry. Of course, I could be wrong, and don't load up on gold stocks unless you understand the risks. I could be completely wrong on this. So you got to invest with your own risk tolerance, but I've got confidence in what I think is going to happen, and so I'm willing to run the risk of being wrong to invest in a certain way.
Yeah, I'm in there betting with you. Thanks, Peter.
Hey, thanks for your call. Think about talking about companies that are having trouble. I'm reading AMR today. Again, can't make a stock recommendation, but just bringing up American Airlines. AMR, the parent company, dropping again today at about $1.85 a share. It's looking like bankruptcy is that much closer to reality as they're having problems coming to agreements with their pilots. AMR stock in early 2007 hit a high of over $40 a share. Today it is trading at under $2 a share. One of the analysts who was following the stock decided yesterday to reduce the stock from a buy to a hold. Of course, it's on the verge of bankruptcy. That's generally what it takes for Wall Street companies to take a buy recommendation off a stock and make it to a hold. Generally, of course, there's not much left to hold by the time they do that. I was taking a quick look on Yahoo Finance at the current ratings, and you still have of the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 firms that are covering AMR. 1, 2, 3, 4 of those firms still have buy recommendations. Only 2 firms have the stock rated as a sell. The rest have a hold. The companies that still have a buy on AMR include Stifel Nicholas and UBS, having the stock rated as a buy, despite the fact that it is on the verge of bankruptcy. And that's generally, how it is in Wall Street. I mean, in these stocks, of course, they're losing a fortune. AMR and all these airlines are losing billions. A lot of it, too, is, the airlines, there are massive taxes involved on AMR. Last time I was on a plane, I read a story, and I grabbed the in-flight magazine. I thought it was very, very well written by the CEO. I think it might have been American. I can't remember which flight I was on, but about all the taxes that are on the airline industry and how difficult it is for them to overcome all these taxes on that industry. And, of course, they have high taxes. They're being hit with inflation because of rising fuel costs. They've got these big outdated labor contracts with these unreasonable demands that are squeezing them. I think this whole industry, as I said, is headed for bankruptcy and restructure. I think there's going to be far fewer planes flying in American skies in the not-too-distant future. And if you're going to want to fly on an American airline, it's going to be much, much more expensive to do so. Anyway, let me go back to the telephones. Next up is Frederick is calling all the way from Sweden. Frederick, welcome to the show.
Thank you. Thank you very much. I want to talk about the European debt crisis. What do you think will play out in the next coming months or the next 12 months when Greece collapse and maybe even Italy and all the many banks in Europe who is heavily invested in these countries?
Yeah, I've been saying that I'm thinking that they are going to come up with a short-term resolution where they put a lot of credibility in the short run behind shoring up these insolvent nations. I don't think it's going to work, but I think it might work in the short run. And I think, look, the euro is, in the face of all this, is behaving very well against the dollar. So that I think is a sign to me that they are going to get over this hump. The euro is going to survive this crisis, though I do think it will survive only to die another day. But I think that there is enough political will right now to keep the Eurozone intact, to keep the euro intact, and there is enough strength in the larger economies like Germany to keep this going. So I don't think you're going to see defaults in Italy, and I don't think you're going to see any of the countries leaving the Eurozone, including Greece, at least not right now. Now, it's possible. Look, I think this whole thing is unworkable and will fall apart eventually. It's only a question of timing and, whether it happens now or whether it happens at some point in the future. My guess, though, is that I think too many people are worried about the Eurozone collapsing and the euro collapsing. I just don't think it's going to happen. I just think the U.S. is going to have its day of reckoning first. Not enough people are worried about the much bigger problem over here, and I think that's where it's going to blow up. I think it's going to happen not where everybody expects it, but where fewer people expect it. And right now, everybody expects the crisis is going to be in Europe. I think it's not going to be there. I think it's going to be in America.
Okay. Have you read about the European Union want to ban rating agencies from giving out ratings to European countries?
Oh, they want to ban them from giving ratings?
Yes. It was. I read a couple of news yesterday about this.
Well, but then they wouldn't have a high rating either. I mean, if you can't rate them, then they would be unrated, and I think that might even be a bigger problem because I think that there are a lot of investments that need a rating, so they have to invest in something that's rated a certain level. And if you basically say you can't rate us at all because you're afraid of a downgrade, well, then you have no rating, and that might be even worse.
I think they want to freeze the current rating. And not
well, then what good are they? Yeah, I mean that'd be like I'm going to go to my teacher and freeze my grades. Whatever you gave me last semester, you have to give me the same grade this semester, regardless of how I do. That would render the grade meaningless. So I don't know that they want to render the ratings agencies meaningless. The ratings meaningless if they want to preserve the high ratings. So I don't know that that's going to happen. But I'm sure behind the scenes, look at how the U.S. jumped all over S&P when they downgraded the U.S. all the way down to AA+, which I think is still much too generous a rating for treasuries. Anyway, I don't know if you have a second part of your question or a follow-up, but we got a commercial break. We'll be right back. If you want to stay on hold, we got one more segment coming up. This is the Peter Schiff Show on SchiffRadio.com. And we are back. This is Peter Schiff here at SchiffRadio.com. Yesterday, Chicago Fed Bank President Charles Evans was on CNBC talking to Steve Leisman, basically confirming what I've been saying, that QE3 is on the way or already here. The Fed is going to get even easier. And, of course, the problem is monetary policy is too easy. Making it easier is going to make it worse. Take a quick listen to what he had to say on CNBC yesterday. Cut number 2.
I would be more aggressive in applying accommodative monetary policy. So the first step I would take is to clarify what we currently mean by the mid-2013 language. And so I would say that we can continue to be accommodative as long as the unemployment rate is above 7%. We're pretty far from that right now. 7% is above what I think is a sustainable unemployment rate. I don't think it presents many dangers. When we get to 7, we'd look at how we're doing. We might continue to do more. This is all as long as inflation remains contained. And by contained, I mean potentially above target, but no more than 3% over the medium term.
Yeah, who knows what that means? We're already over 3% right now. Trailing CPI, even with today's drop, is still 3.5%. So obviously they don't care about inflation. They're going to keep on inflating. And as far as QE asset purchases, that's what he says the Fed should be doing, printing money and buying stuff. Here, listen, cut number 3.
If we found that we were bumping up against 3%, that would tell us that things aren't proceeding the way that I think that they would. Maybe there's another analysis impediment and we're running into structural problems. But I'd like to at least, test that. So then, first part would be to clarify forward language. Second part would be to say, are we making progress towards that improvement? If we find we're not, then we could do more accommodation through some form of asset purchases, maybe MBS, things like that.
So there's where he's talking about QE3, and Steve Leisman asked him to qualify that briefly here, cut number 4.
So just to be clear, you wouldn't be ready to pull the trigger right now on additional asset purchases?
I think that the state of the economy is such that it would be a good idea to do asset purchases. Yes, I would favor that. But first I would say let's clarify forward language. Then let's clarify if we're making progress. Then let's improve the situation.
So in other words, he wants to do the asset purchases now. He thinks we need to do that. He wants to clarify the language first. I don't know what could be more clear. This is what is going to be done. But the illusion, the idea that it's okay, that we can keep on printing money because there's no inflation is a farce. We're already well above what the comfort level would be on inflation. Anyway, let me quickly go to the phones. Next up is Philip calling from New Jersey. Philip, you're on.
Hi, Peter. How are you? A big fan. Been listening to you. You've taught me so much in the last couple of years. And I want to talk on Ron Paul. And as a Christian conservative, when I listen to him on the debates, I just, I can't get around his message. And
Ron Paul's message?
Ron Paul's message, because it just doesn't translate through the debates and stuff. And then, since listening to your show, I became a big fan of Tom Woods, and I listened to a couple of his website pieces, and he made the case for Ron Paul to Christian conservatives, and it was just so clear cut. He made it so clear on why Ron Paul his message should resonate to that sector, and that being such a big part of the Republican base.
Yeah. I mean, sometimes Ron Paul isn't necessarily the best communicator of his message, especially in these debates, because you only have 30 seconds or 60 seconds. So you can't really do it. Of course, if you're listening to a Tom Woods speech and he has a lot of time, he can make a good case. But both Tom and I really support Ron Paul, and I think all the conservatives, Christian or whatever, should be behind him, because he is a true conservative in that he wants to conserve the values that the founding fathers set us up on. He wants to conserve liberty and the Constitution and sound money. There's very few people running that really believe in any of those things.
But I tell my friends about Ron Paul, and they think I'm crazy because of the things he says about Iran and Israel, foreign policy.
Yeah, well, when
you listen to Tom Woods explain it, and there's a piece on his internet, if anybody on his website, if anybody's interested, he just explains Ron Paul's appeal to the Christian conservative, and I think it really would help if you could get the word out.
Yeah. Yeah, and I think, as I said, we should phone bank them. And if anybody is concerned, who better than Ron Paul supporters to address those concerns and help educate people one by one on the phone in these early primary states. Anyway, thanks for the call. Next up is Ian calling from Mississippi. Ian, welcome.
Hello?
Yes, you're on with Peter Schiff.
Yes, I have a question about the gold standard.
Uh-huh.
I talk to a few people on the internet every once in a while, and every once in a while I'll talk to these monetarist people. Monetarists are still around, go figure. But
yeah, well, we had a monetarist on the show yesterday. Anyway, go ahead.
When they're making the case against the gold standard, one of the favorite things they love to say, or at least the ones I talk to anyway, is there's not enough money, there's not enough dollars in circulation to cover the amount of gold there is, and that if we went back to a gold standard now, our economy would shrink by a factor of 50.
It wouldn't shrink. I mean, and the whole idea behind the monetarist is monetarists think that moderate inflation is better than moderate deflation. They believe that if prices gradually rise every year, that's better than prices gradually falling every year. Because under a gold standard, that's what you get. Under a gold standard, the tendency is for prices to decline over time. But when you introduce the monetarist idea of a money supply growing at a certain rate, they're doing that so prices will rise a little bit every year. So they just believe that rising prices somehow are better for the economy than falling prices. And I just think that's wrong. And I think history shows that falling prices are better.
I agree. But another thing they also like to say is that with a gold standard, you don't have the fluidity that you would have under a fiat currency. What I mean by fluidity is banks can't loan out enough can't make enough loans fast enough, so on and so forth, so we don't really get the growth that's desirable.
No, they can make loans. Look, we financed the Industrial Revolution in the 19th century. We converted America from a nation of farms to a nation of factories on a gold standard. The entrepreneurs, the big industrialists, the robber barons who built up this country, they were able to finance everything they did on a gold standard. So obviously, that's just not the case. That's just all a bunch of propaganda by government. Government wants paper money. They don't want a gold standard because they want to be Santa Claus. They want to spend money on they want to pretend there's a free lunch. They want to give away something for nothing. They want the power. Gold puts the power to the people. Fiat money gives the power to the government. So that's the reason they oppose it. Anyway, hey, we've run up to the end of the show. We'll be back again tomorrow. Another 2 hours of the Peter Schiff Show. I'm sorry for the people who are on hold who we couldn't get to. Call again tomorrow. Anyway, this has been Peter Schiff on SchiffRadio.com, the gold standard in talk radio. Bye for now.